Part 1. The Intelligent Investor, Benjamin Graham's timeless secret to building wealth. Imagine walking into the world's largest marketplace. Thousands of voices compete for your attention. One person insists a stock will double by next month. Another predicts a devastating market crash. Television commentators argue over interest rates. Financial headlines change by the hour. Prices rise. Prices fall. Opinions never seem to stop. Now imagine standing quietly in the middle of all that noise. Instead of asking, "What should I buy today?" you ask a very different question. What is this business actually worth? That single question changed investing forever. Long before Warren Buffett became one of the world's most respected investors. Before value investing became a familiar phrase. Before millions of investors searched for hidden bargains. There was a thoughtful teacher named Benjamin Graham. He didn't promise instant riches. He didn't claim to predict tomorrow's market. He wasn't interested in excitement. He was interested in truth. Benjamin Graham believed that successful investing begins not with speculation, but with understanding. He taught that a stock certificate is far more than a number on a computer screen. It represents ownership in a real business. A business with employees, customers, products, profits, challenges, and long-term potential. That simple idea seems obvious today. Yet when Graham introduced it, it transformed the way generations of investors approach the stock market. His philosophy would later influence some of the greatest investors in history. Warren Buffett, Charlie Munger, Irving Kahn, Walter Schloss, and countless others. But perhaps his greatest contribution was not teaching people how to become wealthy. It was teaching them how to think. Because markets are emotional. People are emotional. Prices can become emotional. Yet successful investing demands something entirely different. Clear thinking, independent judgment, and the patience to wait until opportunity appears. These lessons were not created in times of comfort. They were forged during one of the darkest financial periods in modern history. A time when fortunes disappeared almost overnight, when confidence collapsed, when fear replaced optimism, and when investors desperately searched for answers. Out of that hardship emerged ideas that would continue guiding investors for nearly a century. Ideas that remain just as relevant today. This is the story of Benjamin Graham, the man who taught the world that intelligent investing is not about predicting the future. It is about understanding value, remaining patient, and refusing to let emotion become your financial advisor. Part 2. Chapter 2. When the market lost its mind. The year was 1929. For much of the decade, optimism had swept across America. The economy appeared unstoppable. Businesses expanded. Factories hummed with activity. New technologies captured the public's imagination. Stock prices climbed higher and higher. Many investors believed prosperity would continue forever. The market seemed incapable of falling. Ordinary families borrowed money to buy stocks. New investors entered the market every day. Conversations at dinner tables, barbershops, and busy street corners often turned to one subject: the stock market. It felt as though everyone had discovered an easy path to wealth. History has shown that whenever people begin believing prices can only rise, caution quietly disappears. Then came October 1929. Within days, confidence evaporated. Selling spread rapidly. Fear replaced optimism. Fortunes that had taken years to build disappeared with astonishing speed. Many investors who had believed they understood the market suddenly realized they had been driven more by hope than by careful judgment. The Great Depression that followed would challenge businesses, families, banks, and entire communities. It also challenged Benjamin Graham. Like many professional investors of his time, Graham suffered enormous financial losses. Years of hard work seemed to vanish almost overnight. For many people, such an experience would have ended their careers. But Benjamin Graham responded differently. Instead of blaming luck, instead of blaming the market, he asked a more important question: what can this experience teach me? That question changed investing forever. Graham realized that successful investing could never depend on excitement or popular opinion. It required something stronger, a disciplined process, a process built on evidence rather than emotion. While others searched for predictions, Graham searched for principles. Those principles would eventually become the foundation of modern value investing. Chapter 3. The difference between price and value. Imagine walking through an antique market. Two clocks sit side by side. They appear almost identical. One carries a price tag of $50. The other is marked at $500. Without looking more closely, which one would you buy? Most people would immediately choose the cheaper clock. But an experienced collector would ask a different question. What are they actually worth? Perhaps the $50 clock is damaged beyond repair. Perhaps the $500 clock is an authentic antique crafted by a famous maker. Price alone tells only part of the story. Benjamin Graham believed the stock market works exactly the same way. Every day, investors become fascinated by prices. A stock rises 3%. Another falls 5%. Television commentators discuss every movement as though each one carries enormous significance. Yet Graham believed those changing prices often distracted investors from what truly mattered: the value of the business itself. A stock's market price can change dramatically in a single afternoon. The value of a well-managed business usually changes much more slowly. Factories do not suddenly disappear overnight. Customers do not instantly abandon trusted brands without reason. Strong businesses continue serving their customers even while markets panic. This realization gave Graham an enormous advantage. Instead of reacting to every price movement, he focused on understanding the underlying business. If market prices eventually reflected true value, patience would become an investor's greatest ally. Chapter 4. Meeting Mr. Market. Benjamin Graham introduced one of the most memorable characters in investing history. He called him Mr. Market. Imagine owning a successful family business with an unusual business partner. Every morning, your partner arrives at your front door. Some days he is wildly optimistic. He believes your business is worth a fortune. He eagerly offers to buy your share at an extremely high price. The very next morning he returns. This time he appears discouraged. He insists the business is in terrible condition. Now he offers to sell you his share for far less than yesterday's price. Nothing about the business itself has changed overnight. Only your partner's emotions have changed. Benjamin Graham wanted investors to think of the stock market in exactly this way. Mr. Market is emotional. Sometimes he becomes wildly enthusiastic. Sometimes he becomes deeply pessimistic. But you're never required to agree with him. You're never forced to buy simply because he is excited, nor must you sell simply because he is afraid. His job is only to offer prices. Your job is to decide whether those prices make sense. This simple lesson has guided generations of successful investors. Markets constantly change their opinions. Intelligent investors remain focused on value. Chapter 5. The Margin of Safety. Imagine driving across a large bridge. Would you feel more comfortable if the bridge were designed to hold exactly the weight of your car? Or if engineers had built it strong enough to support 10 times that amount? Most people would choose the second option without hesitation. That extra strength creates protection. Benjamin Graham believed investing should work the same way. He called this protection the margin of safety. Instead of paying full price for a business, he searched for opportunities where the market price stood well below his estimate of the company's true value. That difference created room for mistakes. No investor is correct 100% of the time. Unexpected events happen. Economies change. Businesses face challenges. But purchasing quality assets with a meaningful margin of safety helps reduce the impact of those uncertainties. The margin of safety is not about predicting the future perfectly. It is about respecting the fact that the future is never perfectly predictable. That humble idea remains one of the greatest risk management principles ever taught. It reminds us that successful investing is not simply about maximizing returns. It is also about protecting ourselves when life unfolds differently than expected. Part 3. Chapter 6. Investing is not speculation. If Benjamin Graham could offer one piece of advice to every new investor, it might be this: never confuse investing with speculation. At first, the difference seems small. After all, both involve buying stocks. Both involve risking money. Both take place in the same marketplace. But beneath the surface, they are worlds apart. Imagine two people standing outside the same apple orchard. The first person points toward the trees and says, "I think apple prices will rise next week." The second person walks into the orchard. He examines the trees. He studies the soil. He speaks with the farmer. He learns how many apples the orchard produces each year. He understands the costs of maintaining the land and the quality of the harvest. Only after understanding the business does he decide what the orchard is worth. The first person is making a prediction. The second is making an investment. Benjamin Graham believed too many people entered the stock market as speculators without realizing it. They chased rumors. They followed headlines. They bought because everyone else was buying. They sold because everyone else was selling. Their decisions were driven by emotion rather than careful analysis. To Graham, intelligent investing required something entirely different: knowledge, discipline, patience, independent thinking. These qualities cannot eliminate risk, but they can help investors avoid many of the mistakes created by fear and excitement. Chapter 7: Why Emotions Cost Investors More Than Markets. Imagine driving through thick fog. The road ahead disappears. Visibility shrinks to only a few feet. Most careful drivers instinctively slow down. They become patient. They focus on staying safe rather than arriving quickly. Now imagine another driver. Instead of slowing down, he accelerates because he fears arriving late. The danger has not changed. Only his emotional response has. The stock market often creates the same kind of emotional fog. When prices rise rapidly, excitement clouds judgment. When prices collapse, fear does the same. Benjamin Graham understood that the greatest danger was not the market itself. It was the investor's emotional reaction to the market. He believed successful investors must learn to separate feelings from facts. That is easier said than done. Human beings naturally seek comfort in crowds. When everyone around us is buying, buying feels safe. When everyone around us is selling, selling feels reasonable. Yet history repeatedly tells a different story. The crowd often becomes most optimistic near major market tops. The crowd often becomes most fearful near important market bottoms. Learning to recognize these emotional extremes requires practice. It also requires courage. Not the courage to make reckless decisions, but the courage to remain calm while others lose theirs. Chapter 8: The Discipline of Independent Thinking. One of Benjamin Graham's greatest gifts was teaching investors to think for themselves. Imagine taking an important examination. Every student in the room writes a different answer. Would you erase your own work simply because everyone else chose something different? Probably not. You would trust your preparation, your understanding, your reasoning. Investing should work the same way. Markets constantly offer opinions. Television offers opinions. Social media offers opinions. Friends offer opinions. Even experts disagree with one another. Benjamin Graham encouraged investors to develop something more valuable than opinions: a sound process. When your decisions are based on careful research, thoughtful analysis, and a clear understanding of value, temporary disagreement from the crowd becomes much less frightening. Independent thinking does not guarantee success, but blindly following the crowd almost guarantees disappointment sooner or later. History repeatedly reminds us that bubbles are built by crowds. Wise investments are often made by individuals willing to think independently. Chapter 9: The Intelligent Investor Never Stops Learning. Perhaps Benjamin Graham's greatest lesson had nothing to do with accounting, balance sheets, or stock prices. It had everything to do with learning. Markets change. Technology changes. Industries evolve. New companies appear. Old giants disappear. Yet one advantage remains available to everyone: the willingness to keep learning. Every book you read sharpens your judgment. Every annual report deepens your understanding. Every mistake honestly examined becomes another lesson. Benjamin Graham believed investing was not merely about earning higher returns. It was about becoming a wiser thinker. The more clearly you think, the more confidently you can act. And the more confidently you can act, the less likely you are to be controlled by fear. Perhaps that is why Graham's ideas continue influencing investors nearly a century later. He was never trying to teach people how to predict tomorrow. He was teaching them how to make better decisions for a lifetime. Part 4. Chapter 10. Why the greatest investors welcome market declines. To most people, a falling market feels like a disaster. Television headlines become darker. Financial commentators begin predicting even greater losses. Conversations shift from excitement to fear. Many investors stop opening their brokerage accounts altogether because they cannot bear to see another day of red numbers. Benjamin Graham looked at those same moments through an entirely different lens. He asked a simple question: if nothing important has changed about the business, why should I become frightened simply because the price has changed? Imagine walking through your favorite neighborhood. One day you discover that the house you've admired for years is suddenly offered at a 20% discount. The roof is still solid. The neighborhood is still safe. The schools remain excellent. Nothing about the property itself has become worse. Only the asking price has changed. Most people would consider that an opportunity. Yet in the stock market, many investors react in exactly the opposite way. When quality businesses become less expensive, fear often convinces people to walk away. Benjamin Graham believed intelligent investors should do the reverse. Not because every falling stock is a bargain, but because temporary fear sometimes creates extraordinary opportunities. His goal was never to celebrate falling prices. His goal was to recognize when emotion had pushed prices far below reasonable value. Those moments were rare, but when they appeared, patience was often rewarded. Chapter 11. Success is measured in decades, not days. Modern markets move at incredible speed. News travels around the world within seconds. Prices change every moment. Investors can buy or sell with the touch of a screen. The temptation to react has never been greater. Benjamin Graham understood something timeless. The stock market measures prices every second. Life measures wealth much more slowly. Imagine planting an oak tree. Would you dig it up every morning to see whether the roots had grown? Of course not. You understand that healthy growth takes time. The same principle applies to investing. Strong businesses need years to expand. Management teams need time to execute their plans. Innovative products require patience before reaching their full potential. Yet many investors judge success after only a few weeks. They become discouraged because wealth did not appear overnight. Benjamin Graham encouraged investors to think differently. He believed patience was not merely a personality trait. It was a competitive advantage. The ability to wait calmly while value unfolded separated disciplined investors from impatient speculators. Time became their silent partner, working steadily, quietly, often unnoticed, until one day the results became impossible to ignore. Chapter 12. The investor's greatest enemy. When people first enter the stock market, they often assume their greatest challenge will be finding the perfect company. Benjamin Graham disagreed. He believed the greatest challenge sat much closer. It looked back at them every morning in the mirror. The investor's greatest enemy is often the investor himself. Fear, greed, overconfidence, impatience. These emotions quietly influence decisions long before investors realize it. 1 month of rising prices creates confidence. Several months of gains create excitement. Eventually, excitement transforms into certainty. That is often when risk becomes greatest. The opposite happens during difficult markets. Temporary losses create concern. Concern grows into anxiety. Anxiety becomes panic. Panic leads to decisions that investors later regret. Benjamin Graham repeatedly reminded investors that mastering emotions is often more valuable than mastering financial statements. The market cannot force anyone to buy. The market cannot force anyone to sell. Those decisions remain our own. Learning to pause, to think, to question before acting may be one of the most profitable habits an investor can develop. Chapter 13. Building wealth one decision at a time. Many people imagine wealth is created by discovering one extraordinary investment. Benjamin Graham believed lasting wealth is usually built differently. It grows through hundreds of thoughtful decisions made consistently over many years. One wise purchase, one unnecessary risk avoided, one emotional mistake prevented, one patient decision repeated again and again. These small choices accumulate just as interest accumulates inside a savings account. Slowly at first, almost invisibly, then with remarkable power. The greatest investors rarely rely on luck. They rely on habits. Habits of reading, habits of thinking, habits of questioning assumptions, habits of remaining patient while others rush. Those habits become the invisible foundation supporting decades of successful investing. Chapter 14. Benjamin Graham's Lasting Legacy. Nearly a century has passed since Benjamin Graham first challenged investors to think differently. Markets have changed. Technology has transformed Wall Street. Trading floors have become computer screens. Artificial intelligence analyzes enormous amounts of information in seconds. Yet Graham's central message remains unchanged. Price is not value. Emotion is not evidence. Patience is not weakness. Independent thinking is not optional. These ideas continue influencing investors because they are rooted in human nature. Technology evolves. Human emotions rarely do. Fear still drives markets. Greed still creates bubbles. Patience still rewards disciplined investors willing to think beyond today's headlines. Perhaps that is Benjamin Graham's greatest achievement. He did not simply teach people how to invest. He taught generations how to think more clearly. And clear thinking has always been one of the rarest and most valuable assets any investor can possess. As long as markets exist, as long as people experience hope and fear, as long as investors seek wisdom rather than excitement, Benjamin Graham's lessons will continue guiding those willing to listen. The true measure of his legacy is not found in the fortunes created by his students. It is found in the millions of investors who learned that success begins not with predicting tomorrow, but with developing the character to make wise decisions today. Part 5. Chapter 15. The Student Who Changed Investing Forever. Benjamin Graham's influence cannot be measured only by his own investment results. His greatest achievement may have been the minds he shaped. He was not only an investor, he was a teacher. Inside the classrooms of Columbia Business School, Graham shared ideas that challenged the way people thought about Wall Street. He encouraged students to look beyond market excitement. He taught them to analyze businesses, to question assumptions, to think independently. Among those students was a young man named Warren Buffett. At the time, Buffett was already fascinated by investing. He read constantly. He studied financial statements. He searched for knowledge wherever he could find it. But meeting Benjamin Graham changed the direction of his life. Graham gave Buffett something more valuable than a stock recommendation. He gave him a framework for thinking, a way to separate facts from emotions, a way to view stocks as ownership in businesses rather than pieces of paper moving on a screen. Years later, Buffett would often speak about Graham's influence. The lesson stayed with him throughout his entire career. This is perhaps the greatest proof of Benjamin Graham's legacy. His ideas did not disappear after his lifetime. They continued living through the investors who learned from him. Chapter 16. The Book That Changed Millions of Investors. In 1949, Benjamin Graham published a book that would become one of the most influential investing books ever written. Its title was The Intelligent Investor. The book was not designed to teach people how to get rich quickly. It did not promise secret formulas. It did not offer predictions about tomorrow's stock market. Instead, it offered something more valuable, a philosophy. Graham wanted investors to understand themselves, because before investors can understand markets, they must understand their own behavior. The book introduced concepts that remain famous today: the difference between price and value, the importance of a margin of safety, the danger of emotional decision-making, the need for independent thinking. Decades after its publication, investors continue studying its lessons, not because every detail applies perfectly to every modern market, but because the human emotions behind investing have remained remarkably unchanged. Chapter 17. The Quiet Power of Rational Thinking. Benjamin Graham was not the loudest person on Wall Street. He was not famous for making dramatic predictions. He was not interested in appearing brilliant. His approach was quieter, more thoughtful, more disciplined. He understood something many investors forget. The market does not reward intelligence alone. It rewards the ability to remain rational when emotions become extreme. A brilliant investor who cannot control fear or greed can still make terrible decisions. A person with average intelligence but exceptional discipline can achieve remarkable results. Graham believed investing success was less about having a higher IQ. It was about having the right temperament, the ability to remain calm when others panic, the ability to remain cautious when others become overly confident, the ability to wait patiently when opportunity has not yet arrived. Chapter 18. What Benjamin Graham can teach investors today. Nearly 100 years later, investors face a world Benjamin Graham could never have imagined. Stocks can be purchased instantly from a phone. Information travels across the world in seconds. Social media can influence millions of investors within minutes. Artificial intelligence can analyze enormous amounts of data. Yet despite all these changes, one challenge remains exactly the same: human behavior. Investors still chase excitement. They still fear losses. They still buy after prices have already risen dramatically. They still sell after fear has reached its highest point. This is why Benjamin Graham's lessons remain valuable. The tools have changed. The emotions have not. The successful investor of today still needs the same qualities Graham emphasized: patience, discipline, humility, independent thinking, a willingness to think differently from the crowd. Chapter 19. The Foundation of Intelligent Investing. Benjamin Graham's greatest lesson can be summarized in one idea: the market is not your enemy. Your emotions are. The market will always move. Prices will always rise and fall. Predictions will always be made. Opinions will always compete. But the investor who learns to remain calm, analyze carefully, and wait patiently gains a powerful advantage. Benjamin Graham did not teach investors how to avoid uncertainty. No one could do that. He taught them how to make intelligent decisions despite uncertainty. That may be the true meaning of intelligent investing: not knowing everything, not predicting everything, but having the wisdom to act carefully when opportunity appears, and the patience to do nothing when it does not. Part 6. Chapter 20. The Investor Benjamin Graham Wanted You to Become. When people hear the name Benjamin Graham, many immediately think about numbers: balance sheets, earnings, financial statements, stock valuations. And while those things were certainly important to him, they were not the deepest lesson he wanted investors to learn. Benjamin Graham was not simply teaching people how to calculate value. He was teaching them how to develop character. Because investing is not only a financial challenge, it is a psychological challenge. The market constantly tests an investor's emotions. It tests patience when nothing seems to happen. It tests confidence when prices move against you. It tests humility when your predictions turn out to be wrong. A successful investor must develop the ability to remain steady through all of these experiences. That is why Graham believed temperament mattered so much. A person with perfect knowledge but poor emotional control could still fail. A person with incomplete knowledge but excellent discipline could still succeed. The greatest advantage an investor can develop is not a secret formula. It is the ability to think clearly when others cannot. Chapter 21. The difference between being right and being successful. One of Benjamin Graham's most powerful ideas was that being correct about an investment idea is not enough. You must also be correct about your decision. Imagine someone buys an excellent company. The business is strong. The management is talented. The future looks promising, but they pay far too much for it. Even a wonderful company can become a poor investment if purchased at an unreasonable price. On the other hand, a misunderstood company purchased at a significant discount can become an excellent investment. This distinction separates intelligent investing from simple admiration. Many investors fall in love with businesses. They become emotionally attached. They convince themselves that because a company is great, Any price is acceptable. Graham warned against this thinking. A great company is not automatically a great investment. The price you pay matters. Value matters. Discipline matters. The intelligent investor respects both quality and price. Chapter 22. The courage to be different. Following the crowd feels comfortable. When everyone is buying, buying feels safe. When everyone is selling, selling feels logical. But Benjamin Graham understood a difficult truth. The greatest opportunities often appear when the crowd is uncomfortable. During market crashes, fear dominates. During bubbles, excitement dominates. In both situations, emotions can push prices away from reality. The intelligent investor learns to recognize these moments, not by trying to predict exactly what happens next, but by asking, does this price make sense based on the underlying value? That question requires courage, because sometimes the correct decision feels uncomfortable. Buying when others are afraid can feel frightening. Selling when others are celebrating can feel lonely. But successful investing has often required the willingness to stand apart from popular opinion. Chapter 23. The Legacy of a Teacher. Benjamin Graham passed away in 1976, but his influence continues every day. Every investor who studies value investing is connected, in some way, to his ideas. Every person who learns about margin of safety. Every person who studies a company's true worth. Every person who chooses patience over excitement. They are continuing the tradition Graham began. Perhaps the greatest evidence of his impact is not the wealth created by his methods. It is the number of people who learn to approach investing with greater wisdom. He transformed investing from a game of speculation into a discipline of analysis. He reminded investors that stocks represent ownership, that prices and values are different, that emotions can be dangerous, and that patience is one of the most powerful tools available to anyone. Chapter 24. The Final Lesson of Benjamin Graham. If Benjamin Graham could speak to today's investors, he might say something surprisingly simple. Do not allow the market to control your emotions. The market will always provide opinions. It will always offer prices. It will always create excitement and fear. But you do not have to react to every movement. You can choose patience. You can choose discipline. You can choose independent thinking. The intelligent investor understands that wealth is not created by constantly doing something. Sometimes wealth is created by waiting. Waiting for the right opportunity. Waiting for the right price. Waiting until your analysis and the facts come together. The market rewards those who can remain rational when others become emotional. That was Benjamin Graham's timeless lesson. Investing success is not about being the smartest person in the room. It is about having the wisdom to make thoughtful decisions and the patience to allow those decisions time to work. Closing narration. Benjamin Graham changed investing forever. He did not promise a way to become rich overnight. He offered something far more valuable, a way to think. His lessons survived market crashes, technological revolutions, and changing financial systems because they were built on something that never changes. Human behavior. People will always experience fear. People will always experience greed. People will always chase excitement. But those who learn to remain patient, disciplined, and rational will always have an advantage. From Benjamin Graham came a philosophy. From that philosophy came some of the greatest investors in history. And from those investors came lessons that continue guiding generations. The intelligent investor is not the person who predicts everything correctly. The intelligent investor is the person who understands uncertainty and still makes wise decisions. That is the legacy of Benjamin Graham.